Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. We're going to take a look at a lot of different things in this episode. We really want to show you a few very important charts that paint the picture of what is going on underneath the surface on this recent rally here. If you didn't watch the last YouTube video that we posted, make sure to go ahead and do that. We take a look at some of the key indicators that we use from a technical standpoint to assess the market, both for the short term. Market does look a little bit overextended and could provide some buying opportunities, and in the longer term time frame. Before we dive into the more technical aspects of the market, I'm going to demonstrate here in just 2-3 minutes how the S&P 500 could theoretically move down very rapidly to around 1,000 points. I put a support level here. It should theoretically be under that at around 1,000 points here. And I'm going to show you exactly how that could unwind and how, against popular belief, this is actually something that is somewhat realistic and not a scenario that should be completely pushed aside. And by the way, from current levels, 1,000 points is around a 75% drop from current levels, right? So that is quite impressive. And from the top, that is around an 80% drop from the top. So we're going to dive into that. A very simple way through which I like to take a look at the stock market, especially when I try and find out the targets and try and paint hypothetical scenarios, I like to always take it back to the earnings. Now, these are the earnings of the S&P 500, right? And you can see per share of the S&P 500, you'll have around $200 in earnings, $203 in earnings. Now, if we take a look at the S&P 500 PE ratios, these are the valuations of the S&P 500, and you can see it's 20.87. Right, so what is the S&P 500 price? It's just the 20.87 multiplied by 203. If you do that math, you'll get around 4,200 points, which is exactly where we are currently sitting on the S&P 500. Right, so that's just to show you how that works. Earnings times valuation, so PE ratios, equals the price of the S&P 500. That's the basic formula that you need to understand. This is how most strategists make estimates for the S&P 500 and try and understand where it's going. It's through that simple formula. Now you can see earnings tend to go up over the long run, right? As the economy expands, you have long-term growth in the US, and you see company earnings gradually move higher. Now, you do see that there is periods of volatility on S&P 500 earnings. This is what 2000 looks like, right? The 2000.com bubble, and this is what 2008 looks like. In 2008, you had a drawdown in earnings from around $120 all the way down to 20. Earnings were ridiculously small because you had a very severe recession. So let's say we do have a somewhat of a hard landing, a pretty severe recession, and you see earnings come down back to 100, right? So you see a little drop like this on earnings. That wouldn't look very different to some of the other drawdowns in earnings that you've seen throughout the past almost 150 years. So let's say you hypothetically have around earnings of 100 towards the bottom of a recession in 2023, which is within the realm of possibility. If we take a look at the PE ratios of the S&P 500, you could easily see PE ratios during a panic move in the market when you've got a lot of pessimism and people want to move away from risk and move away from very poor growth in the US and move away from stocks. You're going to see that get priced into PE ratios and valuations. And so you could come back down to pretty reasonable valuation levels that we've seen in the past. Around a PE ratio of 10, we've seen that many, many times throughout history, and would be in the realm of possibility for the S&P 500 to have a PE ratio of around 10. Just over the past few months, we've already gone from a PE ratio of around 35 to 20, so you could understand how a move down to 10 would be reasonable. So if we have a PE ratio of 10 with earnings of around 100, which are both scenarios that would look pretty reasonable on those charts, that would take the S&P 500 down to 1,000 points. So that is a very scary scenario to think about, and one of the reasons why we have a much more pessimistic outlook on the stock market looking out 5 to 10 years, because we do believe that's the type of scenario that could be entirely possible in the event of economic headwinds and a revaluation of the S&P 500. Now, this is just a potential scenario. This is not a prediction. This is just to show you what that type of drawdown could look like and what would need to happen to earnings and valuations for that to happen. Now, what we currently expect, and we're going to be posting a few articles on that over the next couple of weeks to give the members on gameoftrades.net a 6 to 12 month target for the S&P 500. I think that is imperative. And we're going to be making a detailed overview of that and taking you guys through that entire process of how we're coming up with our target and also what that means for the targets of some of our other calls on different sectors that we're looking at right now. But the big narrative that we have right now is disinflation and the market trying to front run a Federal Reserve pivot. And this is something that we already saw just last week, an impressive almost 14% off the low. You didn't see massive earnings increase here like you did throughout 2021. No, this was pure valuations. And we've said this many times over the past few months that we think this rally that's coming is going to be driven not by earnings, but by valuations, by PE multiples expanding. And we think we could reasonably see PE ratios come back up here to around 24, 25. Now, current earnings estimate for the end of 2022 by analysts on Wall Street, the consensus estimate is around $228 of earnings per share for the end of 2022. Now, we expect earnings to surprise to the downside. We don't think those expectations are going to be met. We think there's going to be revisions of earnings to the downside and that there's generally going to be quite a few misses during the next earnings season. So that's something that we're incorporating into our analysis for the S&P 500. We're aiming a lot more for something like $215 of earnings per share. So what type of target would that give us for the S&P 500? We multiply 25 PE ratio by 215. That gives us around a target of 5,375 points. Now, again, this is just an approximation. I know this isn't particularly helpful to really serious investors because we're not really providing the research that supports the idea that we could see a 25 PE ratio. So this is all going to be covered in the articles that we post on our website. So make sure to tune in for that, where we'll be clarifying the target for the S&P 500 and using that level providing targets for the other big investment calls that we're looking at. But this is exactly why valuations are extremely useful for the longer term. But in the short term, if you're using PE ratios to predict what's going to happen 6 to 12 months from now, PEs could go up, down, sideways, backwards. The point is that knowing that PE ratios are elevated doesn't tell you where they're going to go. It tells you the risk reward. There's a lot of factors right now that suggest that PE ratios could actually expand in the next few months and not move down to 10. That's something that we could potentially see later in the decade, maybe 2023, 2024. We'll see when we need to watch out for that type of move. By the way, if you're so far enjoying this video, make sure to smash that subscribe button if you're enjoying these episodes, if you're learning something new, and also click on that like button. It really, really helps our videos get pushed out and get seen by other people. So now let's jump to the S&P 500. As we said towards the beginning of this video, we did take a look at the short-term overextension on the S&P 500, whether that's the 8-hour chart showing overextension or the 4-hour chart showing overextension. Very strong overbought readings that also coincided with the tops of these bear market rallies. So, if you're concerned about being trapped by this rally, don't buy when the S&P is overbought, right? I think you can reposition if the S&P 500 gives you an opportunity back to key levels of support. But on the other hand, and this is something that I think is also very important to understand, is when you have recoveries off significant bottoms, like let's say 2018 and 2020, the market has this tendency to stay overbought for significant periods of time. And this is something that, I learned the hard way, that if you're not buying the dip on the way down and you're waiting for that sign of a recovery, you're really waiting for the market to show you that it's recovering, well, good luck, because the market can stay overextended for extremely long periods of time. And perhaps the best buying opportunity you're going to get in that type of environment is just a consolidation, not even a pullback. Now, if we take a look under the hood and take a look at some of the individual sectors on the S&P 500 and how they've been behaving just over the past few weeks, this is XLK, the technology sector, and you can see here we had a clean breakout above this downtrend line resistance, showing you there is a change in character relative to anything that we've seen throughout 2022, right? And I can show you that by adding the S&P 500 on top of this chart. And you can see here we've had this perfect correlation between the underperformance of the technology sector relative to the S&P 500 and the S&P 500 moving down. They've been perfectly correlated. And so what that essentially means is that the technology sector is dragging down the S&P 500. So seeing this breakout is promising. It shows us a change in character, but you could definitely see this get retraced and potentially retest that level before moving back higher again, right? That's entirely possible. Now we have a similar development on XLY, which is the consumer discretionary sector. So consumer discretionary spending is spending on non-essential goods. So when you see the consumer discretionary sector, XLY, perform very well, like for example, the recovery you had post-COVID here and what we're seeing now, this is generally a good sign for the economy. It means consumers are pretty healthy, they have a lot of buying power, and you can see that's also very different to anything that we've seen throughout 2022. And I'm going to add the S&P 500 again on top of this chart so that you see the perfect correlation between XLY moving down and underperforming and the S&P 500 underperforming as well. And now that we're seeing this recovery on XLY, we're seeing this recovery on the market as well. If you're a member gameoftrades.net, you'll know that consumer discretionary has been one of our favorite sectors for quite some time. We've been expecting it to outperform the rest of the market. In fact, on the 24th of June, we took a look at this indicator here, the breadth, that was extremely oversold. And it told us that looking out 12 months, the average return following that type of reading. Now, there were only a couple of readings, but nevertheless, the average return was 63% looking out 12 months. Those are absolutely monstrous gains, and that's with a 100% win rate. So every trade worked out. So you can quickly read what we wrote here. This would theoretically take XLY to $228 by June 2023, currently at $140. So we love to see that this setup falls in line with our fundamental driven data research article that was posted the week before, because that's how our research process works. We first build a thesis, trying to understand the odds and whether the macro is going to be favorable to that sector. Once we establish whether that's the right answer, then we can take a look at the technicals, the internals, and establish some entries and targets for that sector. This is saying that the market went on too much of a panic in 2022 and that we should be repricing what the actual economy looks like right now. In fact, if we take a look at the MACD on the S&P 500, we have a bullish weekly cross. So although you do have some short-term overextension and we could see a little bit of a pullback, this is a constructive look. Now, if we don't have a V-shaped recovery, because we don't have a crystal ball, if let's say oil begins to move back up here again, and it does look like it's at some sort of a level of support here, right? It's holding above this support. If we all of a sudden see oil break out above this downtrend and move back up to $110 before moving back down, and following through on this head and shoulder pattern, the S&P 500 would retrace this entire move very likely because inflation expectations would skyrocket again and bond yields would start to move higher again, and the Fed would need to again adopt a hawkish tone. So you would see this move get retraced, and instead of a V-shaped recovery, which is what the market seems to be doing right now, instead of a V-shaped recovery, you would see a bottoming process start to develop. And these are the targets that we're looking at for that bottoming process, which we believe would be extremely favorable entries if we do see those levels again. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that subscribe button. Now, in the meantime, I wish you good luck on your trading and see you next time.